Hi everyone, it's Mike from Order Flows, and welcome to the Order Flow Dynamics course, Module 6 on order flow rotations. Now, one thing that traders have to realize is that all markets rotate. Now, what is a rotation? Well, earlier I talked about vertical and horizontal markets, right? Markets tend to rotate more in horizontal market conditions than vertical. A lot of traders think that when a market goes sideways, it is rotating. Now, market rotations give traders opportunities to get into trades at good levels. Now, oftentimes one of the problems that traders suffer from is market rotations. They get caught offsides in market rotation. So for example, if the E-minis has a rotation of 3.5 points, which is about 14 ticks, the market moves up 10 points and then starts selling off 2 points, 3 points, and you think the move is over and you get short at 3 points and a worse 3.5 points from the high, and bam, the market reverses and starts going higher again. You just got caught in a rotation, right? The market went up and then it's going to pull back about 3.5 points. And then instead of thinking that, oh, this is it, the high is being put in, that you get short, the market's going to sell off. The market is just in a rotation before it goes higher. All markets rotate, so knowing the rotation will help you keep you out of bad trades, as well as help you know when to get into trades. One of the easiest ways to know when a market is rotating is using the zigzag indicator. Now, it can be used on, pretty much every trading software out there has it. You just got to look for it in your indicators, and it helps a lot of people understand market rotations. After a while, you won't need to be using the zigzag indicator, but this is what it looks like on a footprint chart, right? It has these lines going up and down. It's not necessarily swing highs, swing lows, but it's showing the market rotation, right? You see the market goes up, comes off a little bit, goes back up, comes off a bit. And every market has a different rotational aspect to it, as well as different chart types. So you can't look at a 1-minute chart type and trade the rotation the same as you would a 5-minute chart type, just as you wouldn't trade a 4-range chart rotation the same as an 8-range chart rotation. And traders get mixed up on intraday rotations when they start thinking a market must adhere to its average rotation. And for example, say the E-mini has an average rotation of 3.5 points, but after 4 points it hasn't rotated. 6 points, then it goes to 8 points, and finally it rotates around 10 points, right? Then it goes back to the 3.5 to 4 points. Rotations are not set in stone. I know people that have tried to do studies on rotations, and basically, they'll look over the last, year or two of data. You can't go back too far because, you don't want to be taking a rotation that occurred in 2016 and putting weight into it now in today's market, right? In 2016, the markets, didn't move as much. So, the rotations were smaller. So if you go too far back, it's kind of not useful in your analysis. But, there are people that will go back and look at all the rotations, on say a 1-minute E-mini chart just to find the average. But you got to realize it doesn't rotate in an average. Okay, sometimes the rotation might be 3 points, sometimes it might be 5 points. Then if you're just going to take the average and you'll call it 4 points, well, you're not gonna take full advantage of the rotations when they occur. Rotations vary. This here you can see on this chart, this is about rotation up is about 5. Rotation down is about 2, back up about 5, and then you got a rotation down of about 7, up about 2, down about 10, up 5. So, if you're taking an average in the rotation, say, well, the average is 5. Well, once it starts rotating down and it's a 10-point move, you start buying it at 5 points, then it goes to 6, 7, 8, 9, 10. You're going to find yourself in some losing trades. So, again, rotations are not set in stone. Now, traders often struggle where to get in on a prevailing trend. By understanding rotations, it's going to help you more easily enter a trend move because the markets rarely move in a straight line. And rotations are going to give you a chance to buy the dip or sell the rally. So if you understand that markets rotate, okay, you will be more willing to buy the dip, all right? Instead of thinking, well, we got to sell off, at the first sign that if something is bullish, that the dip is being put in, All right, you come back up and make a new high, you pull back. This is your chance to get long. If you understand that the trend is up, right? If you're thinking the trend is down, you're wrong. Instead, you should be looking at trading the rotation in the opposite direction. But if you understand that, we're in a trending up market, anytime you come off a high by a certain amount of points, you should be thinking of buying it. Here we come down into the low, rally up, come off about 3 points, 4 points, rally back up, come off a couple of points, rally back up. If you understand that we're selling off, okay, you get your rotation before you sell off again, right? Most people will get stuck on rotations thinking, well, disregarding rotations. Take it out of your brain for a second. The market's coming off, and then they start seeing something bullish. Okay, we're going back up to take out the high. However, if you understand that the market's rotating, right? Even though the order flow looks bullish, right? You got a delta surge here, 223, 464, 605, but it can't go any higher. Okay, rather than being married into your trade, maybe you're getting long here, looking for the market to go higher. Then you realize we're not going higher. This is not a prominent point of control, but it's point of control up near the high. You can see what's happening in the delta here. It was 770, it closed at 340. Then the next bar, max delta is just 5, min delta is 412, final delta is 368. So instead of thinking, oh, we're going higher here, what you should be changing your thought process, thinking, well, we're not reversing and going higher. What we have is a rotation, and as we start going down, you can understand. You just look at this rotation, 46 up to 50. It's about a 4-point move, and that's your rotation, telling you get short. Market's going to continue in that direction. Sometimes the rotations are a bit choppy, right? And unfortunately, the market is not a beauty contest where every chart is going to look really nice. You can see this one is from about 43 down to 40, back up to 43, back down to 40, and then puts in from 40 up to 41, back down to 37. So you have this little bit of chop, but what's happening is the market is rotating. Okay, so you got to be understanding that, on horizontal moving markets, markets in a trading range, look for those rotations, right? This market is mostly moving in a horizontal pattern, all right? You can understand that, this is your high. You come down here, people say, this is your swing high, swing low, swing high, swing low, lower high. Okay, what's happening? Well, that's what market's rotations are. Whoops. The market is rotating back and forth. And understanding that, and then if you understand that you're in a horizontal moving market, the average rotation is about 4 points, 3.5 points, then you could start, trading the edges of the horizontal move. All right, so let's talk about rotations in trends. Rotations in trends occur all the time, and think of rotations like this, right? There are forces in nature that we just can't fight against, such as the current tide of the ocean, right? The tide is either coming in or it's going out. And yet, during the different tides, there are always waves approaching the beach or waves, receding from the beach. And when you want to go into the water and swim, you time your entry based on what the waves are doing, right? You usually go into the water when the wave is receding, even though the tide may be coming in. So the overall tide is coming in, but the wave is receding. That's when you're going to go out. Now, suppose the tide is going out and the wave is receding. Oftentimes, if you do that, they always say, be aware of what the tide is doing, because if you go into the water when the tide is, going back out, the wave is receding, you can find yourself further out in the water than you want to be. And to get back in, you're going to need another rotation. You're going to need another wave to get you back into the beach safely. Now, substitute the tide for the prevailing trend in the market and substitute the waves for the market rotations, right? Where traders often get lost is watching the rotations and mistaking them for the prevailing trend. Long-term traders are focused on prevailing trend in the market and ideally enter on rotations. They don't always. Short-term traders are focused more on rotations but need to be aware of the prevailing trend. So on rotations, when a market sells off from an intraday high by a certain amount of points, that high will not be tested again on that day. In the past, honestly, that used to be more true than it is now. Honestly, these conditions that we're in currently in 2020 are unlike conditions I've seen. I've seen them in the past, because I've been trading since the 90s, but it used to be a lot more rarer. It used to be a lot safer to say, when a market sells off from an intraday high by a certain amount of points, that high is just not going to be tested again. But under these conditions, nothing holds true anymore. The reverse is true when a market rallies from an intraday low. When a market moves from the low by a certain amount of points, the low is in for the day. So you'd want to get out of any shorts. So, let's take a look. So rotations away from a high. And, the markets often get to a point where, here you can see a rotation. This rotation is about 20 points, 32.20 down to 32.02. Such a big rotation like that, it's going to be very, very difficult for the market to rotate back up to the high. Right now, you can't have a big rotation. Here's a rotation from 08 up to 14, but again, it's a smaller rotation. You can see most rotations are generally 4 points, 3 points in the E-minis. But when you get a big rotation, chances are of it going back up to the high are quite slim. So you put a 20-point rotation there, then from 08 down to 90, so it's almost 20 point. That's about 18-point rotation. So you got two big rotations down. So the chances of it obviously going back up are quite slim. Okay, now here, right, this is a rotation, right here is about 31, we'll call it 3160 down to 3150. It's only a 10-point rotation. Now you're seeing some nice, 10-point rotations. I hate to say are normal on the market like this, but this is a 10-point rotation here. You got another 10-point rotation right here, another 10-point rotation here. This one is about 10 points here. So, 10 points, it's within the realm of a normal trading day. When you start seeing such big rotations, that are just blowing out your daily average rotations within the day, then it's probably not going to come back up to the high. Now, when looking for a potential high, most traders look for a reversal bar, a single bar to signal a reversal. But a single bar can be misleading. Often you have to look at the bar after the high is made and combine it together. All right, so what do I mean by one bar is not a rotation? Is here we have the high, swing high right up here, and we start coming off. We're starting to put in the rotation. Okay, so you look for the surrounding order flow to confirm that we're starting a rotation, right? And then coming back up again, you're starting to see something in the order flow with the aggressive buying coming in here, right? Then we reverse down. We got another rotation coming in here, and then we rally back up. So once you understand rotations, right, you start to see them everywhere, unfortunately, even areas that are not rotating. So in other words, times where the market could legitimately be reversing. So how to tell the difference? Well, you got to read the order flow, right? Watch the delta, watch for imbalances, watch for bars that snap back on thin volume in the footprint. So here, right, we rally up, we get a swing high, we got a bearish prominent point of control, we come down. Okay, so is this going to be a rotation on a way down or sort of a rotation on the back up? Well, we got a bigger rotation, right? We took out sort of the swing low area in there, so chances are this is going to be a rotation on the downside. But you got to be watching what's happening in the order flow, right? We're starting to rotate back up. It looks a little bullish here. You're seeing some positive deltas being strung together, higher points of control, buying imbalances. Then you got the point of control up near the high of this bar. You got a single print there too. You got selling imbalances coming in. Okay, probably going to be a rotation down now, right? This is our rotation back up. Now we're going to be looking for a rotation back down. How to determine if you're in a rotation? Again, watch the order flow. Okay, we got a nice rotation up from 31.20 all the way up to 29.30 area. Then you pull back here. So is this going to be your swing high? Is the market going to start selling off again? Or are we going to rotate and go higher? Well, market starts selling off. We got some bearish signs in here, right? Obviously we got 3 red bars. We got lower points of control. The delta is kind of mixed. 326 is negative. strong one, but 40 is nothing, 73 is nothing. You get down here, you got something bullish in the bullish point of control, bullish in the order flow. You're coming in here, you're seeing some nice strong positive delta growing, 73, 228, 330, 569 even. But now you can see, oh, you know what? This is probably just a small rotation. Look for the market to go back up rather than thinking that the market is going to keep selling off. Right? Market is rotating here. Now, another easier way to mark rotations is look for probes. You know, it's what I call a probe. It's a candle wick basically, and a probe up that comes after a period of weakness means, you know, a new high or sideways activity. It's a good sign the market is ready to sell off. And in downtrends, you know, second attempts to test a high, you know, chances to shake out weak longs. Optically, it looks like it's about to break loose higher, but when the selling comes in the second time around, it looks like the market is often falls over is what's going to happen. And when it has extra heavy volume, it looks even better. So for example, all right, signs of a weak rotation. All right, we got our swing high, we start coming off, coming up, coming back up. Here you have long wicks, right? Long wicks, and you know, candlesticks guys will say, well, you know, you got your pin bars there. That's a very bearish sign. But what's happening is, you know, the market's trying to rotate higher in both cases, but it just can't. Right? Then it comes back and closes. Notice I don't have the zigzag indicator on here. Right? It just, by now, hopefully you should be training your eyes to be able to notice that. And then, of course, you know, when you take into account what's happening in the deltas, you know, negative, 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 stronger. You got a negative delta here, lower points of control. You know, then you understand, yeah, you know, the market is probably going to be selling off, because what's happening is people are buying it here. They're trying to get it up past the swing high to see if they can trigger stops or something like that, or trigger new buying coming into the market. Okay, here, market goes up, we come off, right? You got your wick here, you know, your pin bar. What's happening? You're trying to probe back into this area that we were earlier, right? See if we can you know, find acceptance here. So if you could find acceptance here and start trading inside this area that we just were, then the market's got a stronger chance to go down rather than come in, reject that area and go higher. If you come in here, start seeing that you're rejecting this area that you're in here before, yeah, this is your rotation down. We got our swing high, we rotated down into, you know, this previous area that we're trading before, and now we rally back up. All right, this is a nice rotation to the upside that you can tell by when the market probes back into an area that we just were. Okay, so this one is, you know, not as clear because it's on a you know, within a minute, but market comes down, goes up a little bit, comes back down in here, probes this area that we're just testing in here. All right, and it rejects that area, and then we go higher, go sideways, and then rotate back up. So your rotation, you know, if you're looking at, say, a zigzag line, it starts over here, comes down, comes up, goes back down, goes back up, comes back down in here, and then goes back up. Okay, so where do you want to be looking for these probes, right? So you're going to look for these probes after periods of strong selling or strong buying. You're going to look for the up probes after a strong buying move up, because what's happening during the move up is institutional selling is appearing, right? There's distribution going on. Once that supply has been adequately distributing, the selling rotates as it decides which direction to go next. But really, the direction is down, right? What's happening is the retail traders think the market is just getting primed for a move higher, but in reality, the institutions are just reloading their guns, so to speak. So what happens? Market's going up. You've seen some strong activity going on. You see some strong institutional selling. There's distribution going on. The market starts coming off. Okay, and you know, then it starts, you know, rotating around. You know, it's sort of going sideways, and retail traders think, oh, this is it. You know, the market's getting ready for a move higher. When really, what's happening is institutionals are just letting the market breathe for a while before they start selling again, and you know, all the retail traders position themselves long, thinking the market's going up, but reality, the institutions are just getting ready to dump more inventory onto the market. So remember, rotations occur in all markets. Knowing your market's rotation will enable you to work stops and take profits more effectively. markets do overshoot rotation. So if you think that, the E-mini average rotation is 3.5 points and it moves 10, that, it can't move to 10, you're going to get screwed a lot. You got to understand a rotation stops when a rotation stops. Don't think that average rotation is 3.5 points and you got to be buying and selling every 3.5 points. No, that's the wrong way to use rotations. Now, some traders will use pivot points as levels for rotation. I think using the zigzag indicator is going to help you see rotations a lot easier and become more comfortable in seeing them. So this concludes Module 6. In Module 7, I'm going to discuss initiative and responsive order flow. So I'll see you there. Bye-bye.